Well, we've certainly had a lot of developments over the last couple of weeks. Let me take you back to the 30th of April, when the overall market was 7% higher than it is today. The banking stocks were 9.5% higher, and the resource stocks were 7% higher as well. Since the 30th of April, of course, we had the announcement of the Henry Review and the government's response to that. And of course, the big issue there was the resource rent tax. A fairly complex tax. A couple of issues, however, that really stand out is that basically what the government is trying to do there is arguing that because resources are in finite supply and are owned by the Australian people, then they should have access to any super returns from companies that extract those resources from Australia. And hence the introduction of the tax. That, of course, has taken its toll on the resource sector, but what we do need to bear in mind is that the financial sector is down by 9.5%, and the overall market's down by around about what the resource sector is down by. So there have been other factors that have been weighing on the global markets. Of course, the Greek situation is terribly worrying. The Greeks, the Spanish, the Irish and the Portuguese have about $1.2 trillion worth of government bonds on issue. That compares with about 1.4 trillion in Germany, 1.5 trillion in France. So they are big issuers of bonds. And of course, banks are now worried about what other banks are holding those bonds. We know that, for instance, German banks hold about 5% of their assets in these toxic waste bonds, similar for French banks, fairly similar for Belgian and for Dutch banks. And so what we've seen in the last 2 weeks is banks starting to get a little reluctant to lend to other banks. LIBOR has blown out from 25 basis points to 45 basis points. And so the whiff of a credit crunch is now starting to settle over the global markets. And that, of course, is most disturbing for the Australian banking system, because Australian banks are such big users of global capital markets, and they've become even bigger users over the last couple of years. Last year, Australian banks issued over 200 billion of paper, which is 10% of their assets, and that compares with about 2% of the issuance of their assets of the issuance by, say, US banks or European banks. So that's what the main reason, I think, why the Australian banks have been hit so hard, and hit even harder than the resource sector, because of this fear of their over-reliance upon the global capital markets. So what's the outlook for the world economy going forward? What's the outlook for the resolution of the Greek situation? The problem for the Greek situation is that the providers of the Stabilisation Fund, being the other European Community and the IMF, are imposing very tough guidelines on Greece. The objective is to get their budget deficit down from 13% of GDP down to about 4% of GDP, and that means cutting costs, cutting wages, cutting spending, which is a very nasty way to solve a fiscal problem. The Asian crisis, that's how they got out of the Asian crisis, but they had the additional benefit of a currency of currencies such as the Korean won, the Malaysian ringgit, etc., that fell sharply, that allowed them to get their growth in export markets, because the rest of the world was doing very well at that period. Whereas this time the Greeks and the Irish and the Spanish and that can't benefit from a fall in the currency, because they're in the euro, and the world economy is not a very pleasant place at the moment. Europe showing no growth at all. The US doing better, but as I've said in previous discussions in this medium, I'm quite sceptical about the ability of the US to maintain its momentum, and Asia will not be immune. We know that the Chinese are trying to slow down their housing market, and the data indicates that they're slowing down the growth in infrastructure investment. Construction is about 2/3 of the demand for steel in China. The other third is motor vehicles, and of course for Australia it's all about steel. It's about black coal and iron ore, and China is the dominant story there. There's 65% of world imports of steel, 45% of world production of steel, and we say, what about India, Russia and Brazil? Well, they're 10% in total of world production of steel, and those countries of course don't import steel. So it really is a China story. I'd be very surprised if the Chinese are prepared now to appreciate their currency, given the very narrow margins that their exporters have, and now given the fact that they've lost competitiveness in Europe with the fall in the euro. So lots of uncertainty at the moment, and uncertainty of course weighs on equity markets, and we're seeing that resolving itself now. I have to say to you, in the last Australian Financial Review poll for forecasting came out was asked for about 3 months ago. My forecast for the index was in the mid 4,000s, and the next lowest number was 5,500. So even though I've been correct on that, I don't feel too happy that forecast has turned out to be right, given the sharp movement that we've seen. The interest rate story is unclear now, given that the Reserve Bank will be taking into account the concerns with the global financial crisis. However, I think the overriding factor on interest rates is going to be inflation. We saw the Reserve Bank board minutes today. They are worried about inflation. Inflation hasn't bottomed out at the level that they expected. They're now talking about it remaining near the top of their confidence band for the next couple of years, and that's at a time when capacity is going to be further tightened as the mining boom proceeds, and because the terms of trade, increase in the terms of trade, the increase in incomes in this country are pretty much locked in, given that we've already seen the renegotiated prices for black coal and iron ore. So prepare to see slightly higher interest rates. Of course, if we move into GFC Mark II, then of course interest rates won't be going up, but I'd be very surprised if the global policy makers would allow the world economy to fall back into that sort of abyss, given what happened to the world economy following the failure of Lehman Brothers. Thank you.